So Rebel set the stage for the really bad news that we have here. And what we have is a panel that's prepared to discuss the implications of all of this for the world of real estate. And I think what I'd like to do is ask the panel if they we'll just go down the line, if each of you will introduce yourselves, say just a bit about your firm and what you do, and the issue that you most particularly want to talk about today. And then I'll just sort of help to moderate the conversation a little bit, because we really do mean this to be a conversation, not a series of presentations. Jim.
My name is Jim Collegian. I'm the chairman of REIA and a principal with Pathways Senior Living, which is a assisted living company that's involved in service delivery. We currently have 600 employees. We're very concerned about the current economic condition. The reason why I wanted to have this meeting is because I'm tired of industry publications telling us how good it is. With a 5-minute research on the internet, I discovered about 500 sources of information that tells me the real story. So that's what the perfect storm is about. It's not about a depressing meeting where you walk away talking to yourself. It is about how you prepare for the storm, the right boat, the right coat, the right attitude. So this is about how you prepare your plans for the coming double recession in 2013. So what I'm going to concentrate in is the impact of the revision of the tax code and the new Obamacare taxes on investment and capital fundraising. And secondly, the impact of the act for individual business operators and how they're going to adjust to national health for their employees.
And Neil Freeman.
Hi, I'm Neil Freeman. I am both involved with DePaul. I've been an adjunct professor for a long time, probably about when people started to be born here. Suzanne and her organization runs a great program. I also am chairman, CEO of Aries Capital, which is a mortgage banking and real estate finance company, and CEO of a company called Urban Development Fund, which has received over $400 million in new market tax credits from the government. We specialize in new market and historic tax credit deals. First of all, I would like to thank Rebel Cole. That was a fantastic overview of the perfect storm, and it was so great that I'm going to go home tonight and commit suicide. But seriously, I think I'll be around tomorrow. I'm going to focus on various programs as we get involved in a lot of financing programs involving real estate, and since the banks have basically disappeared from lending, certainly construction lending, in about 2008, so it's been 4 years or more, and some, as Rebel said, have just disappeared. There's slack that's been picked up by various programs, and a lot of those programs are governmental in nature. And as I go and talk to people running these programs, including our company on the new market tax credit, every one of these programs is either materially changing or sunsetting September of 2012, right now. Congress has enacted, and what is the issue for the economy of these various programs if they either disappear or are greatly reduced? And these include the EB-5 program, the new market tax credit program, various SBA programs, the 504 and 7A, various HUD programs, especially the 221D4 program, which is for new construction and major rehabs, which isn't doing very much right now. And globally, both on the single family and multifamily side, Fannie Mae and Freddie Mac, as Rebel's slide showed, on residential, it's probably 95% of the market. On multifamily, it's probably 60 to 70% of the market.
And Jerry Nudo? Will that work?
I'm Jerry Nudo. I'm a partner at Mark Realty, which is a local firm that manages and owns primarily B and C office buildings in the loop and a number of the suburbs. It's approximately 4 million feet. And recently we've been buying distressed condominium conversions and converting them back to apartments. I'm going to talk about some of the issues that face developers in terms of the tax consequences that would happen when 2013 comes, what it means, and other things that you face in terms of financing and the equity that you have to put in new deals and how that's going to change going forward for some of the new people out there and anybody starting over.
Hi, I'm Don Meyer. I'm founder and principal of Loan Management Solutions, a firm we started in the summer of '09 to focus on working with banks as they dealt with their problem loan portfolios. Prior to that time, I was the chief investment officer of Centerline, which was the third largest CMBS B-piece investor in the country and special servicer. I've been asked to talk about the issues that borrowers are going to face in the next few years. There is a tremendous amount of CMBS debt that's going to come due over the next 3 and 4 years, and you're going to have to deal with special servicers. Each of them has their own motivations. Each is frankly different, has different motivations from the other, and you'll get very different responses based upon the motivations of the special servicer, and also to talk about the issues that a borrower will face with a maturing loan at a bank, and what is the difference between having a maturing loan at a healthy and growing bank, a bank that is barely treading water, and a bank that's in danger of failure.
Rebel? Rebel's here just with bad news all day.
My students call me Professor Cynic, so I'm the cynical professor. You already heard from me, so I'm going to turn it over to Charlie.
Thank you. I'm the optimist. My name is Charlie Wurzbach. I joined the real estate faculty at the fall in 2009, following a 20-something year career heading up institutional real estate investment management firms such as J&B Institutional, Enlightened Capital Management, and Henderson Global Investors here in North America. So the bulk of my business life has been running organizations that invest capital on behalf of pension funds, endowments, and foundations in real estate and real estate products. So my focus is primarily sort of understanding and looking at investment opportunities in terms of the current environment. So my focus is, given the comments that Rebel made, particularly relative to two things, which has to do with the employment and then the penalty box relative to the zero interest rate policy, the opportunities and the risks associated with real estate investment. Because I always believe that whenever there's a lot of turmoil in the marketplace, there's an awful lot of opportunity that is also available. But the key is to understand and correctly evaluate the risk. And I think that in real estate in general, we get seduced by low interest rates, and we don't always think about the consequences of that when 5 or 7 years are up and we're trying to exit.
Thank you. So I think what I'd like to do is start and ask Don if he'd sort of kick off this discussion. The place that Rebel didn't have the graph is the one that shows the giant run-up in CMBS that falls off, as we say, a cliff, and the implications of that, partly for 5 years out, but mostly for 10 years out. So we're looking at 2016, 2017, that we're going to have this huge number of dollars of CMBS maturing. And so, as I said, some of it is now and some of it is 5 years from now. But I'm intrigued by your thoughts about the different attitudes, the way that special services are working, the likelihood of success doing some of the refinancing now and what we're going to face in 5 years.
Okay, well, it's a very, very complex issue, and I'll try to keep it as simple as possible. The real issue is a CMBS, really think about it, if you think about it as two tranches of debt. You've got the people who own the senior bonds, the AAA, and all they want is their money back and the interest rate that they agreed to on the day that they thought they were going to get their money back. The maturity of your loan. It's that simple. If they don't get their money back, they want somebody to take action and make it happen now. The special servicer typically has owned the very bottom piece, and his motivation is he bought his investment in that piece at probably about 30 cents on the dollar, but he's getting an 8% coupon or so on 100 cents. So in round numbers, if he gets interest payments for 4 or 5 years, he's gotten all his money back. What he really wants is a couple of different things depending upon who he is and what his motivation is. My old employer, Centerline, was raising money from pension funds and invested over $1 billion in CMBS securities, most of them the first loss pieces. And when they were raising money from pension funds, they were as focused on keeping the pension funds happy as they were anything else to get the next dollar of money to manage. And those pension funds were also investing in AAAs, and so there was a balance to the equation. That equation's gone. In 07, there was about $250 billion of CMBS issued. In 11, there was $12 billion. In 10, I think there was none. There's not new money coming in, and so Centerline has been, the special servicer has been purchased by an entity that more than anything wants to acquire the most attractive properties that secure loans that are in default. And the owner, a special servicer, can buy out of a CMBS security any loan at the value of that loan at the time of default. The value of a loan is actually the value of the property less the cost of collection and the delay in getting title. So that guy has an opportunity to buy the asset at a discount to the value of the asset. And frankly, what he's really looking for is pay me at par or give me the property. You'll get a very different response from that kind of special servicer than you will get from, for instance, Midland, which is a very large special servicer that does not own B pieces, that's owned by a bank, that is looking to just fulfill its responsibilities. They quote, have a fiduciary responsibility to the AAA holders, and so they want to collect loans at maturity, but they're willing to work with you. So you'll get a very, very different response, and I think that the main point that you want to keep in mind is know who's on the other side and know what their motivations are.
Now let me say, we do mean this to be a discussion, and so we are pretending that we're on leather chairs seated around a coffee table here, right? Instead of at this barrier. So Jim, I think you wanted to ask a question.
Well, I wanted to get Rebel's response. I believe the seeds of the European crisis were established in 1946 through the Marshall Plan, when the U.S. government supported the socialist parties in Europe to defeat the communists. And you go fast forward 60 years as they created this utopian state where nobody works, nobody reproduces, and everybody's retired, what is going to be the future of Europe?
Now, Jim.
They make great food and wine.
Now, Jim. Where's the vote?
I mean, will it become one gigantic museum?
I wasn't born back in 1946, so that even predates me. Again, I kind of outlined my best guess for what's going to happen is the Germans are looking for a way out. The Germans and the Northern Europeans work, the Southern Europeans play, and the Southern Europeans have been spending, the Northern Europeans have been saving. So Germany needs an out to avoid having to bail out Southern Europe. They can't withdraw from the Eurozone themselves, because if they do, they'll have the same problem that Switzerland had last year when their currency appreciated by 50%, and they were forced to buy hundreds of billions of euros by printing Swiss francs. So essentially, Switzerland, which wasn't even in the euro, is having to bail out the Southern Europeans. So the only way Germany can get out of this conundrum is to force austerity onto the Greeks and the Spaniards so severe that they will bail out of the euro. That's the ultimate plan. The ECB, the European Stability Mechanism, the bailout funds, this is just to provide, to make it look like we're trying to fix the problem, but the game plan is for austerity to kick the Southern Europeans, especially Greece is a foregone conclusion. They're going to be out of there within a year. But then the question is Italy and Spain.
Will the collapse of the euro create another recession in the United States?
Undoubtedly. And the best possible outcome I can see is that we have two euros. We have a northern euro and a southern euro, so that the southern European countries can devalue their currency, as Iceland did following the crisis.
So we can send them our Confederate money?
Okay, so let's sort of focus. Let's try to
call them zeros, right?
All right. So what we need to do is we advertise this, that we're going to be talking about some real estate, and I was thinking about Don's answer on who you're dealing with, whether you're dealing with a servicer with a conflict of interest, basically, or whether you're dealing with one that has a motivation to work things out with you. So, Jerry, you're a borrower. Are you dealing with these CMBS? Can I ask you those questions?
We're dealing with...
You want a microphone?
I'm sorry. We're dealing with one special servicer, and they have a conflict of interest, and they have been the most miserable, unpleasant group to deal with. They have their approach to the world, and it's their way or the highway of litigation. And if you get caught in one of those scenarios, it's extraordinarily difficult. And in our particular situation, we face what a lot of developers do, which we've owned the property for 20 years. We have a huge negative basis, and giving the property back without trying to buy it back is going to create an enormous tax consequence to us. And when you're in a situation where you're going to owe almost as much in tax as you would to buy the property back, you're motivated to try to work with them to buy it at a market price. Their view of the world is we make money in fees, we want to do what we want to do, and it becomes almost impossible to do it without creating the tax consequence that makes our lives extremely unpleasant. So when you get with these guys where their motivation is to get the property, make fees, and to then make more fees by selling it, you get caught in a terrible trap.
I might just comment on that tax issue. Every CMBS special servicer tries to figure out what is the tax basis of the borrower, because people keep loans current in order to defer or delay the tax event. When we work with banks and advise them on dealing with loans that are facing default, we try to figure out what is the tax basis of the borrower, and we always try to find a way to make sure that we keep that calculation in mind, because it does keep loans current that would otherwise default.
What happens once they're in default?
Once it's in default, every sophisticated lender works hard to use all the tools at its disposal, and one of those is if to essentially say to the borrower, if you don't do what I want done, you're going to face a tax problem that won't benefit me, but I know that it will motivate you, and so you always, as a lender, try to include that in your quiver of tactics.
But once you're in default, the choice is either you buy the loan back or you give up the property. So either they sit down and say, okay, we think the property's worth $10 million, you pay 10.5, and everybody walks away. I haven't even seen that level of motivation.
And that's frankly, your suggestion is what I think most lenders who are lenders want to do, which is, if the property's worth $10 million, pay me the $10 million for what the property's worth, and give me a tip, you know.
I agree.
For the value of.
But that's not a special service.
But that's not the special service.
They want the property because they make more money dealing with the property than they do selling the home.
Right, and there's almost, and anything that extra that you pay for the value of your tax position has no value to them. The value to them is to get control of the property. That's what I was trying to address earlier. There are enormous conflicts in that industry that are very, very problematic.
We've been in litigation now for 3 years. The property's gone down in value by $40 million, and they still don't. They're unwilling to even talk. They've cost their bondholders 2/3 of the value of the bonds, and it continues to go down, and they continue not to talk because they have such a massive conflict of interest.
I'm not going to dispute any of that, and we structured that industry based on the premise that the special servicer had the same interest or an aligned interest with the senior bondholders, and in the future of the industry, and we've destroyed that in this past cycle, and it's going to be a problem for CMBS for years to come.
So do you see a solution, Don, in 5 years?
No.
You don't, right?
So I guess the question is, where is the money going to come from?
Right.
You know, when you had $250, $300 billion of CMBS originated in 06, 07, and most of those loans are coming due 2016, 2017. If CMBS gets back to $50 billion a year, you still have a couple $100 billion shortfall. Is it coming from banks? Is it coming from private funds? Is it coming from other forms of investment? I mean, the reason people invested in CMBS, at least on the AAA level, is they were getting a highly rated bond. So where's that? That's the question of one of the perfect storm is the maturity defaults.
Right.
What's going to happen both now and the future?
Isn't there $1 trillion of maturities coming about?
About $1 trillion, yes, over the next few years.
So, but it's, of course, I guess it's not really $1 trillion because it's not worth that anymore.
Well, somebody thinks it is, right?
Evaporated. So Neil, can you talk a little bit about who has stepped in the place of the CMBS and what you see? We do see some construction lending. We do see some starts.
I think it's, well, first of all, there's two different questions. The first one is who stepped in. So far, there's been a lot of, both from some special servicers, unfortunately not Jerry's, but from some special servicers, and from a lot of financial institutions, including bank, there's been a lot of what people call extend and pretend or kicking the can down the road. Kicking the can down the road was a pretty good strategy in 2009, 2010, because the values had gone down significantly in most areas of commercial real estate, including multifamily. Today, a lot of those values have been restored, and now the problem is really a debt underwriting problem. I'll give you an example. I'm involved in a property, I have a small interest in a property, that it was a 5-year loan, not a 10-year loan, just matured earlier in 2012. Loans current, CMBS loan, non-recourse. The property is performing okay, but you know, when the loan was done, it was about a 90% loan to value. The value's probably dropped by 10% because cap rates have gone up, and now you can get maybe a 75 or 80% value. So on a $15 million loan, there's a $2 or $3 million refinance cap, and the question is, who eats that? You know, you can give, other than negative equity tax consequences, you can give the property back to the lender because it's a non-recourse loan if the lender wants it. And if they don't, then you can either work on a discounted payoff, or they could kick the can down the road. The property has plenty of cash flow to pay the debt, and you could bring on a new agency loan. You could finance this thing at, let's say, a senior loan of 3.75%. If somebody could figure out how to come up with $2 or $3 million or more equity. So those are the issues. So I think that the first question, you have had banks that have, you know, people haven't called most loans. If you've got good borrower with performing properties on a cash flow basis, even if they're difficult to refinance. You do have a CMBS market that is taking some things out, and then some of these other markets, the second question, new construction. Banks really haven't done very much new construction, and what they have done is more 50 to 60% with very strong borrowers. So almost all of the new construction and major rehabs has come from various programs providing subsidies to get these deals done. You know, we are in the new market tax credit business. You take a $20 million deal, and if you can get subsidy of new market tax credits of $2 to $3 million, if it's a historic building, you might get another $2 to $4 million of historic tax credits. You might get some TIF, tax increment financing, from the government. There may be state historic or new market tax credits or other items, and then you end up where you've got a $20 million deal that maybe wouldn't get done because it's only worth $15 million once you complete it, but it only costs you $10 to $12 million to build it because of these subsidies. The new market tax credit program is out of allocation. It's about a $35 billion program. It was started in 2003, and there is a part of a tax extender bill to add 2 more years at $3.5 billion each.
Does it expire in December?
It's basically out. The last allocation, of which our firm got $45 million from the federal government, was allocated, and there hasn't been an approval of the new round. There is an application, assuming there's going to be approval, but
and when would that approval, how would that approval happen? Does that happen in this lame duck session?
It could happen in the, it probably could happen in the lame duck session. There's a tax extender bill that takes care of things such as the alternative minimum tax and the marriage tax penalty and all these things. You know, it extends the alternative minimum tax, for example, for couples from $45,000 to almost $80,000. That's one of probably 20 different provisions. New market tax credits is one of those items. That's how it got approved the last round. Will it get approved? It's more likely than others, but I don't know. The EB-5 program, which over 90% of the investors in the EB-5 program, this is an immigration program where people from overseas, about half of them from China, invest in U.S. businesses. They have to invest $500,000. Really, it's $1 million per investment, but if you're in a qualifying area, which is basically a low-income area, you can get it for $500,000. And you get a green card, a path to a green card, for you and your family. It's a great program because it costs the U.S. almost no money. You're not giving a tax credit to somebody. You have a foreign investor who's putting capital to create at least 10 jobs and bring in at least $500,000 net of fees and everything else. But you know, the program sunset September of 2012. It hasn't been reapproved. It probably will get reapproved, maybe in the same type of thing. Some people want to go back to $1 million minimum. This program was kind of inconsequential until 2005. In 2005, there were 345 individuals that invested this $500,000 or more into U.S. businesses. Over the last 3 years, it's averaged over 3,000. It's grown 10 times of what the level was, less than 10 years ago. So now that's a $2 billion program. And again, these programs are all multiplied. The UB5, usually there's debt, there's other equity. So that $2 billion a year is probably $6 billion. New market tax credit, it probably helps create $10 billion of investment. SBA 504 is a $5 billion a year program. It's not going away, but the limits were tripled a couple of years ago as part of the stimulus package, and that could well drop back. 221D4 is one of the only new construction apartment programs, and now the wait for HUD is at least a year and a half, and that program could well go away with budgetary constraints. So if you add it up, you've got about $20 billion worth of programs, which is probably $50 billion worth of activity. And this is the hard deals. These are the new construction, major rehab deals that are affected, that create jobs, and that could go away.
Let me ask you a question. I got a statement and a question, Neil. I have the dubious honor of being a participant in an EB5 deal, which I believe is a phony magnet. It attracts so many phonies in this business, it's unbelievable. The key factor of an EB5 deal is, can that office close? Can they actually raise money? Can they close transactions? Because the average EB5 deal is about 12 months.
Yeah,
that's just a statement.
No, it is, and as a result, for somebody to wait 12 months, it had to be a pretty tough deal that couldn't get financing elsewhere. The cost of capital is very low. The investor gets virtually nothing. They get, hopefully, their money back within about 5 years of principal and about 0 interest. The consultants and the consulting, and if they get their money back and a green card, that's what they want. The consultants and intermediaries, get 4 or 5% interest and some fees off the top, and do a lot of paperwork and hire a lot of lawyers.
Yeah, the regional offices load up these deals. You do secondary financing, let's say for $10 million. The borrower gets 3. The regional office gets 5 points on a $10 million loan annually for 5 years.
Is that the business you want? You want to be in that business?
You're just jealous.
No, that's the business we have chosen. Right?
All right. I would like to shift gears just a bit, because I think that Charlie said he would
loan annually for 5 years.
Is that the business you want? You want to be in that business?
You're just jealous.
No, that's the business we have chosen. Right?
All right. I would like to shift gears just a bit, because I think that Charlie said he was actually the optimist there on the end of the table. So there are some really interesting issues about the aging population and as the baby boomers retire, and the necessity for the pension funds to begin to pay out significant amounts of money to the 10,000 people a day who turn 65.
Right. Yeah, I think that one aspect of the perfect storm conversation that hasn't been brought up is in fact that demographic factor, which is true, that in the United States today, 10,000 people reach the age of 65 every day. And the reason that that's significant to the real estate market is that the financial balance sheet and planning and needs of that group as it gets larger and larger is for more and more yield. They switch their portfolios from a growth portfolio to a yield, their personal portfolios, from a growth portfolio to a yield portfolio. The problem is that there is no yield. With 0 interest rate policy at the Fed and 10-year treasuries are close to 0, we all know what the interest rates are. Your ability to adjust your portfolio is really limited in terms of yield. The area where there is relatively attractive yield is the real estate area, even though cap rates have come down in certain very, very popular areas. Now we've seen the consequences of this going after the yield by the institutional investors, where over the last 36 months there's been a tremendous shift towards first CBD office, core properties, well-leased, well-operating properties that had relatively high cash flow. And the strategy there is that you go in, you get that well-leased property, relatively high cash flow, and you lever it, not 90%, but 50% or 60%, so that you have a very high-yielding asset that is relatively safe. Of course, when everyone does that, more and more capital comes, cap rate gets bid down, the yield drops, etc., and then the capital has to go find something else. That something else has been multifamily. The dynamics of multifamily, which are going to continue for the next couple of years, have to do with the perfect storm insofar as not only do we have these continued foreclosures and people have to go somewhere after they, unfortunately lose their home, but the other aspect of it is, and I have this conversation with my students all the time, is the new generation of future home buyers don't want to buy houses. They aren't interested. They saw what happened to their parents and their net worth. They understand the dynamic of losing the mobility factor to go take that, better job in Colorado or California or New York or wherever, wherever it happens to be. So there's sort of this tremendous continued demand for multifamily. The nature of the multifamily that's going to meet the needs of those tenants is changing quite dramatically. But the point is, and the optimistic part of it is that the construction side of the marketplace, while it has increased dramatically in multifamily, to be sure, doesn't look like yet that it has gotten to the point where we've reached the old days of the overbuilding, because it still now requires equity to do a development, which is makes it tough on the developer, but that's really the sort of the governing factor that we need to have in the marketplace. It's really necessary. So overall, when the question is where's the money going to come from to refinance the CMBS market and therefore recapitalize the real estate market, it's not going to necessarily come through, if you will, the traditional CMBS market, because the overall marketplace has been burnt pretty significantly on that, and we haven't really figured out how to do it. But I think that the biggest opportunity is as the pension plans move from defined benefit plans, which means you work for the state or the company for 20 years or 25 years, and when you retire, there's a formula that gives you a defined benefit on a monthly basis for as long as you live. That's a defined benefit model. The market is moving away from that to a defined contribution framework, which is sort of along the lines of the 401k, where you own your own, if you will, pension plan, and you have a lot more control over the investment, etc. The challenge is, how does real estate prepare and develop vehicles that will capture that marketplace in the defined contribution area, because that's really the next big slug of capital that is out there that is going to be looking for high yield investments that real estate can offer. So the good news is, and the sort of that optimistic news that I was talking about, is given the demographic changes in the United States, that there's going to be, and this is global, by the way, it's not just the U.S., it's the same thing in Europe, where you have the aging of the population, where there's going to be this need for yield. Choices today require that you increase, if you will, your risk in order to take higher yield. But if we can develop the right kind of products for real estate, traditional real estate equity investment, that's really, if you will, the coming marketplace, or sort of come out of that recession, significant recession mode, and make some allocation changes. So the trends that are going on is that real estate allocations are increasing rather than decreasing. Now they're not going from 10% to 20% of the portfolio. They're going from 10% to 11 or 12. But that's trillions of dollars. That's a lot of money. The other thing that's happening is that the targeted rate of return of the pension plans are being, the actuarially determined required rates of return are dropping, but they're only dropping a little bit. So they're going from, if they're at 7.5, they're going to 7.25 or 7, which doesn't have that significant of an impact. But the point is, it keeps the pressure on yield. It keeps the pressure on identifying, yield in terms of overall performance. So I think there's partly there's that answer. The big overhang or the big risk that I see, however, for real estate investors is you have to take a view, a macro view on what you think is going to happen with interest rates. And you have to make that bet every day in your investment portfolio. And what I mean by that is, so you're going out, I'm on a real estate investment trust board, we just approved a $100 million line of credit, 275, all right, 275 basis points is the cost of that $100 million line of credit off balance sheet financing, all right? Oh, that sounds great, that's really exciting, you know, go out and invest in real estate, et cetera, and you can see how that works in terms of the leverage. The problem is, or the risk is as you go 3 years out, or 5 years out, or 7 years out, you tell me what your holding period is. And then you tell me what the interest rate is going to be at the end of that holding period, because you know that real estate is always going to be a capital-intensive asset. That's going to require a new investor who has a takeout of some kind from somewhere to have a new note to finance that new price. And if you think interest rates are going back to mean reversion, where rather than having 10-year treasuries at the current level, they go to 4, and you say, okay, well, what's my spread? 2.5, so that puts it to 6.5. The difference between that 4% note that you're getting today versus 6.5 is going to have a significantly negative impact on the value of the property when you're trying to get out. And the risk that people are not paying attention to is to understand the planning of their capital structure in their portfolio and to be able to react. So it's great news if Bernanke comes out at 2 o'clock and says, you know, we'll give you another year of that zero finance, but you better look at your portfolio and figure out what your exit strategy is, because ultimately, unless you think rates are never going to rise, ultimately there's going to be a buyer out there that has to pay more for that debt, and it's going to have an impact on your price. So it's, some people would tell you you're not making a real estate equity investment today, you're betting on the term structure of interest rates. And that's what's going to drive the success of your overall performance in your portfolio. So there's a little bit of a story of that bubble that we saw in the mortgage market developing in the commercial real estate market because of where rates are now. And these interest rates that are low, you know, don't kid yourself, they're subsidized rates. All right, the entire term structure of interest rates in the U.S. is subsidized by the U.S. Treasury. QE3, right, is the Treasury going out, or the Fed going out and buying bonds. That's what it is, all right, and demanding in the marketplace to buy more bonds to keep interest rates down. And the reason for that is they can't print any more money any faster. It's not possible. It's the last tool, you know, essentially, primarily the last tool that they have. So they're buying these bonds to keep the rates down. So we're all on the dole on the interest rate. All right, so I don't think it's just those people, whoever they are. We are all on it, and it's all subsidized by the government today.
I have a comment regarding senior housing. I'm a senior housing operator, developer, and health provider. There's going to be 41 million people over 65 in the next 20 years. Of that 41 million, approximately 10 million will be over 85. So this means that if you're in good health when you're 60, the good news is more likely than not you'll live to 85. The bad news is more likely than not you'll live to 85. Out of that 41 million person growth, approximately 60% or 24 million have savings of 0 to 25,000. So you have a huge low-income population of 24 million. The opportunity is who can come up with a system to house them and provide services to them. So there are opportunities in this growth rate. But remember, what's society going to be like when you have 41 million 85-year-olds?
I hope we're still walking.
We should be, yeah. But
you'll get one of those scooters on TV where you don't have to pay any money. It all comes from the benefit.
So Jim,
What's that?
Jim, we're 15 years away. I mean, aren't you premature in the senior housing business? Aren't we 15 years away from when there's a really significant...
Yeah, the current industry now is building up so they can sell into the wave.
Right.
So the wave's coming, but it's not here. Although a lot of developers believe they can continue to overdevelop because they'll catch an imaginary wave.
Right. So I did say we meant this to be a conversation, so this is not the end of the morning. As you know, we once a year we do this slightly longer morning. But I would like to ask if there's anyone in the audience who wants to chime in with a question or a comment now. I don't want to make you wait until the last few minutes here. Yes, please. You want to stand up so we can hear you?
Sure. I have a couple of questions. So, with jobs, until real estate development, actually, what percentage of jobs is real estate development in this country? Because it seems until that kicks back in, it's, you know, running Home Depot and all the different things that people are doing, it has a huge impact on us.
Have you been to Home Depot recently?
I have.
Have you noticed that they're actually courteous? They've hired a whole new class of people who actually used to have other jobs. Yeah.
So there's a lot of illustrious candidates?
I think they're serious.
My answer to that question is that if you think about a traditional concept of full employment, which, you know, depending on, in the old days it would be 4%, it's probably like 6%, we're trying to get to 7%, but whatever the concept is of full employment. Under that kind of an economy, on a stabilized full employment economy, the real estate sector and all of the periphery spending that is generated by it. So, right, you know, when you go out and buy a house, the first thing you do is go out and buy a bunch of crap to put in the house, right? So that's a periphery stimulation in the economy. That depending on how you measure it, that's 20 to 24% of GDP. Okay? That's the guys with the hammers, you know, all the way to the guys at Home Depot, to the guys at Sears selling appliances. You got to fill your garage with crap, park a new car in the driveway, all of that kind of stuff. So that's sort of the answer to it. It's huge. The other aspect of it that is so difficult is that I was looking at the recent employment numbers, and what you find is that there are about 3 million jobs available and unfilled in the United States today. 3 million, because the workforce does not have the technological skill and capability to take those jobs. So what that means is that the guy who was the roofer with the nail gun, right, lost his job. He's not qualified to do anything else. He doesn't have that technical skill. We bought a house in Florida and put in a new, what was it, U-verse TV. This kid comes, I mean, I couldn't believe the technology that he had to deal with and be capable of. Just, you know, it's not the old cable guy, oh, take the coax and stick it in here, you know. He's on the internet and, you know, doing all kinds of stuff. So the gap in terms of education and preparation is huge. And my fear is that those people are lost. Our ability to get to 7% is really significant, in the short run, to me, is really, really significantly limited by the lack of training and technology and science that the people have. But the answer to the question is a huge part of the, you know, GDP, 24%.
Yes, sir.
I think I'm still stunned by the perfect storm and trying to get out of the boat. And in that context, can the panel connect the dots to taking the concept of the perfect storm to the seller of real estate and the buyer of real estate?
Well, certainly the buyer's going to be cautious, extremely cautious. We've seen that this year, at least in our industry, we've seen that this year. I think we'll continue to see caution as that buyer estimates the impact of his investment strategy with the tax changes, specifically dividends and capital gains. The seller is going to have to do his research to find out who actually is closing. Because I think we're going to have a pause.
So, Jerry, why don't you pick up the microphone?
This is one of the benefits if you're an owner of real estate and can finance it. In a situation like this,
maybe we should, you know, I don't know if that microphone's working. You want to try that?
This is a situation where if you're an owner of real estate and have access to capital, this is one of the benefits of an economy and situation like this. You're able to buy properties at fractions of the cost. Typically, many of the sellers are financial institutions who don't want them. We looked at a building in Schaumburg that we had offered $14 million 5 years ago, and we ended up buying it for $7 million. The guys who bought it paid $19 million. So you're just able to buy things at dramatically cheaper prices. So this world is going to create a lot of very good opportunities for people who have access to capital, assuming that the economy doesn't get a lot worse.
And what about the question about sellers?
Sellers are going to, unfortunately, unless they're selling apartments, deal with a very difficult market, and generally going to have to take a lot less than they had anticipated, you know, a year or 2 or 3 before.
Yeah, I don't, I'll be a little bit more optimistic here. You know, I think that Jerry's right. If you have financial institutions that have taken it back in deference to our friends who are bankers out in the auditorium, but banks don't know crap about what to do with real estate or notes when they get them back. Whatever the right decision is, they're usually about 180 degrees on the other side. So they like to sell high, sell low and buy high, or make loans high and sell low. So they screw up the asset, don't know what to do about it. They sell it when it's empty, and then somebody smart like Jerry who brings in some capital, fixes it up, and creates value. But if you're a seller that has a well-managed property, right now the good news, other than these you know, new construction type things, but the good news is there is financing. There's debt out there, not at 90%, but there's debt at 60, 70, 80%, depending on the type of asset, at historically low rates. I mean, we're financing 10-year CMBS on hotels at like 4 3/4 interest rates, and on, you know, commercial properties at 4 1/4, and multifamily agency stuff again is under 4% for 10 years. So if you're a buyer going long, you can get your capital, and there's a ton, as Charlie said, there's a ton of equity. So there's a lot of developers who are out with created funds with institutional partners on the pension fund side that have a lot of money to go buy assets. So, you know, if you have an existing asset with existing cash flow, certainly if you're in a major market, the prices are unbelievably high, and if you're in a secondary market, they're not that bad. But if there is distressed property, there are tremendous opportunities.
So let me follow up a little bit on something you said, and then we'll get your question. Don, in terms of dealing with the banks, Rebel talked about the number of community banks that are likely to fail, and clearly that the situation that the bank is in is going to have a significant bearing on your ability either to buy something from them that they own or to deal with them in any other way. I know you've got a lot of experience with the community bank world. Would you talk about that?
Sure. There are 2,920 banks in this country between $200 million and $5 billion in size as of June 30. Roughly 30% of those have acceptable earnings and decent capital. That means you've got over 2,000 banks that have $2 trillion in assets that are that don't have enough capital and earning space. You're going to get a very different response when you go to talk to those banks about either new financing for a project or refinancing. If you've got a bank that is just treading water, they are sick enough that they're never going to thrive, but healthy enough that they're never going to die, and that's a very large percentage of those banks in that $200 million to $5 billion range. They don't really want to make a new loan to you. They especially don't want to make a loan secured by real estate. If you've got a loan that's maturing, they are willing to kick the can down the road, but sometimes. But you know what, if they're sick, they don't want to go to war with you though either, because going to war, filing an action creates a problem for them at a capital level. They have to carry it in a different manner than if it's current. The accountants are trying to close a bunch of the loopholes. They can't give you a 3.5% extension because it'll be called a TDR, troubled debt restructure. But you'll deal differently with them than we're doing a job right now for $1.5 billion bank that is very healthy. Has bought a couple of institutions by raising capital around the board table. They are under an agreement they got a term sheet signed to buy an $800 million bank that's one of these sick enough to never thrive, healthy enough to never die, but they're never going to grow. And our client is looking to buy this bank, and they're asking us, tell us what's the market value of every problem loan. Because what they want to do is buy the franchise in order to grow it, and that $100 million or so of problem loans, they want to put it behind them because it doesn't help them.
And how do they do that? What do they do to get rid of that?
I don't find it the case. I've dealt with a couple of these banks. They seem to be very unreasonable, like they're charging They seem to be very unreasonable.
My cost of capital on non-accrual loan is 18%. So if I wait for 3 years, I'll take 50 cents on the dollar today rather than 100% 3 years from now.
Get that guy's name.
And Social Security number.
Maybe I'm looking at it wrong. I
don't think you're looking at it wrong. I think the question is, who are you dealing with? And my point is that.
No, but I think Don's point.
It's going to be very different. You're going to get a very different response based upon where that bank is, how it acquired its assets, and what its focus is going forward.
Well, I got to talk to you after this.
So we have a question here. Yes, sir.
You seem to have some.
A large portion of my business is real estate taxation, and no one has commented on the effect of real estate tax and the projection of the future of real estate taxation on our industry.
Okay, good, Jim.
On the property tax?
Right.
You're talking about the property tax? Right.
Yeah.
Well, obviously, we have a dichotomy in this country regarding how municipalities and states spend money. Look at Chicago. Given the current trend in Chicago, there will be a concession, in my opinion, to the school teacher strike. There's no activities at all at the local and state level to solve the fiscal crisis of the state. And what will happen is continual and long-term property tax increases until the owners have an inability to pay. And usually when they do, they vote with their feet and go to other municipalities or other states. There's a reason why you can be a citizen of Florida 6 months and a day and not pay taxes in Illinois.
Okay, I think we had another issue that we were going to get at, which was tax related, with on the issues about capital gains and changes in taxes. I think, Jerry, were you?
Do we have time?
We do, and we've got about 5 minutes.
I was going to focus on somebody who might lose a property in foreclosure this year versus next year. If you're in the state of Illinois, next year taxes will be 28.8%. That's almost double what they were. So it's more than a 60% increase. So if you add a $5 million negative, your tax bill could be $1.5 million. That you may say, well, it's a non-recourse loan, I can walk away from the property. You owned it for 10 or 15 years, you refinanced and bought a new property, which you lost. Now you're in foreclosure on this property. You go, oh my God, maybe I'll just file bankruptcy and call it a day, because I don't have $1.5 million. I lost the new property that I built because it wasn't in the right market. I over-leveraged this property. But you need to be aware that there are 3 things that bankruptcy does not terminate: alimony, student loans, and an IRS lien. So you're now faced with a situation.
All 3.
And many have all 3.
That's real estate.
So you really need to be aware that the new capital gains laws are going to dramatically affect a lot of real estate people who have been able to hang on for this period of time. And you're going to create a new class of developers called zombie developers. They can't file bankruptcy because that's worse, and they can't do anything else. And then we've been taking what's called bonus depreciation, which has been 100% of your capital expenses, or 50 depending on the year. So we've dramatically increased our negative basis. That is supposed to go away. So now you're going to have a lot more ordinary income coming off of real estate. You have to fix the building, so you got to put it back in. So you have no real cash, but your income is going to look dramatically higher next year. And those rates are going to go up with the new Obamacare add-on. So you're starting at 39.6 if you show any kind of money, that show over 250,000 of income. Then you add the 3.8 to that plus the 5% state, you're at approximately 50% tax. And if you're having a building that has been largely depreciated, you're having to fund capital, you're now in a situation where you have a very significant tax bill with no ability to pay that. And if you're in a market where it's, you know, a suburban office, your ability to sell it is very limited. So you're facing with what's going on in the future for a lot of real estate guys, a very distressing situation. And so this fiscal crisis that they're talking about for a lot of real estate guys who managed to hang on is going to be very real.
So we want to wrap up here in the next few minutes, but could I just ask everyone, and I think I'm going to make Jerry start because he gave us the worst news of the day. Is there any good news? Outside of the apartment market, which everyone is talking about, can we sort of sum up a little, is there something out of all of this that makes you think that there are potential investment opportunities, some things that you see that...
The 2 good things that we're seeing, and maybe there's more, are 1, interest rates are extremely low, and if you aren't over leveraging, you can borrow money long-term at very attractive rates, better than I've seen in 40 years. We've been locking in rates on about 3/4 of our portfolio so far in the low to mid 4s, and I just locked in a $13 million loan at 3.9% on a downtown office building for 10 years. That lowered our cost of capital very significantly, and we're slowly starting to look at buying properties, and we're buying them at, you know, 30 cents, 40 cents on the dollar from where we were seeing them a few years ago. So the good news is if you can still stand up, there's great buying opportunities and the best financing I've ever seen.
Don, what do you think?
I would echo a little bit what Jerry just said. Buying assets at 30 or 40 cents against what you would have paid for them 5 or 6 years ago is in fact something that is occurring out there. We are reaching agreement on what the value of assets are, and from that base we're going to have the ability to effect transactions and get assets into healthy hands that want to grow them out of hands that don't have the capital to grow. So I'm actually fairly positive about the prospects for the next 3 years or so for people who did not get killed and have some capital.
Charlie?
I would agree with that. I think we're going to look back on the 2010, 2011, 2012 period, and the next couple of years as you know, some of the best times to have invested in real estate, in all kinds of real estate. have to evaluate the risk carefully and have to really watch the balance sheet in terms of how interest rates change over time, but I think it's tremendous opportunity.
Yeah, I think that supply and demand, you know, there isn't a lot of new construction. There are people who are tired and running out of money and have not done the right things for the property. So I do think that there are opportunities. For example, an area that we do a lot of financing in is the hotel space. You know, the last couple of years, the RevPAR, basically the gross revenue, has been going up about 10% a year between rate and occupancy. That's probably going to continue 5 to 10% for the next 3 or 4 years because there's very little new construction, and there's a lot of retirees who are traveling more and international people who are traveling more. So I think there are opportunities. You know, where there is these dislocations and problems, the entrepreneurs who hopefully are in this audience are going to figure out a way to profit based on other people's misery.
Jim?
As Charlie outlined earlier, the opportunities, I would say, for young people are senior housing services. Right now in today's market, we see existing properties selling for the cost of new construction, and obviously the opportunity today is in new construction. The ability to design new facilities, to implement new facilities, especially at today's interest rates, can create significant cash flow at, if you can believe it, 15 to 20% cash-on-cash returns at stabilization.
So the last, I'd like to turn to Rebel now. I know that you're the finance guy, not the real estate guy. Do you have any good news for us, Rebel?
What's next to real estate news? If you own a house, this is the best time to refinance.
All right, I'd like to thank the panel very much. And as I said before in my pitch about the program, David Keene is here, and he's going to wander around and pick up business cards from those of you who are interested in learning more about our program, and in particular getting a copy of the annual report, which will be off the press in the next few days. Thank you.
Just real quick, I'm Roy Rendino, one of the REIA board members. I'd like to thank again the panel for a great presentation, and just wanted to make a pitch for two things. First is REIA membership. It has a lot of value. If you like programs like this, talk to Debbie on the way out, pick up an application, and join a great group in networking. Second, our next program should be very insightful. It's concerning the election and what are the impacts of the election. We have 2 state senators, we have a state representative, Republicans, Democrats. Should be an interesting discussion on pre-election, what the direction could be depending on what happens in November. So I think it'll be an interesting program, insightful. We may have to puzzle Jim a little bit on that one. But that is October 18th, Thursday, October 18th. Thanks everybody for coming. We look forward to seeing you.